Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, good afternoon, everyone. It is 4:30 p.m. here in New York, so we're going to go ahead and kick things off for this afternoon's webinar. Thanks to all of you for joining us. Today's session is going to be hosted by Jason Ayres, who will be teaching us about income strategies for ISE FX Options. Jason is a frequent host of ours here on our webinars, but for those of you who don't know him, he's the president and founder of OptionSource.net, providing education and opportunities in the stock and options markets for over 5 years. OptionSource.net is one of Canada's leading educators in trading stocks, options, futures, forex, and commodities. So without further ado, we're going to go ahead and turn it over to Jason.
Great stuff. Well, thanks very much, Katrina, and always a pleasure to be working with the ISE. And I guess, as always, just a quick confirmation that the audio is working properly before I get started with this afternoon session. Good stuff. Looks like I'm okay. Fantastic. Thanks very much for the confirmation. So what we're going to be focusing on here this afternoon is a look at a couple of income strategies that we can implement utilizing the ISE FX options. And the question actually came up: well, are we looking at an entry level or an intermediate type of strategy? So I would in fact classify this tonight's presentation or tonight's session as a focus on a little bit more on the intermediate side of things, because really you do need to have an understanding of how the options market works in general, and some basic understanding of the the dynamics of options pricing in order to implement some of these strategies. So nonetheless, even though it might be intermediate level, I think that there's going to be lots to be learned for people of any level. So I don't want to discourage people from not sticking around. Now, with that in mind, Katrina already gave a little bit of an introduction about myself, and of course I know there's and recognize a number of names online who I have the opportunity of presenting to sometimes on a day-to-day basis. So thanks very much for the support in that regard. As always, we're going to be talking about some relevant market insights and ideas here, and I always just want to remind everybody that before you actually move forward and start clicking the buttons and transacting any live trades in your account, just make sure that you understand the risks involved in utilizing options and understand those risks before you actually take action. A little bit of insight, first of all, on some of the characteristics of ISE options. It's just something I like to remind everybody about, simply because we do have new people joining us from time to time. One of the great benefits of the ISE FX options product is the fact that they are accessible through any standard options broker. One of the limitations for people who want to trade their views on currencies is that they may not necessarily be able to access the currency market without opening up an account at a different broker. So the great benefit of understanding how the FX options market works is the fact that you can typically trade your views on the U.S. dollar against any of the major currencies within the same account that you would actually be implementing any of your option strategies on. They are cash settled in U.S. dollars, which means ultimately that there is no underlying product that is delivered. Ultimately, the difference in your position is settled out based on your strike price, and of course, the settlement price at the time of options expiration. European-style exercise, which means ultimately, if you are an option writer, which is what we're going to be talking about here this evening for the most part, you cannot be forced to settle the trade before the expiration date hits. So simply because, again, there's no underlying to exchange hands. So the ultimately the position is held until expiration, and as the option writer, you don't have to worry about a little bit of a surprise midway through the expiration cycle when somebody decides they want to take action on their long option position. What we're going to talk about tonight also is the fact that these options can be traded as spreads. So many of the option strategies that we would be looking at utilizing through the equity markets, we can actually also implement utilizing these ISE FX options, except of course for the covered call strategy, which requires there to be an actual underlying product available for delivery. I also want to remind everybody as well the FX Options weekly outlook that we provide for the ISE on a weekly basis. If you're interested in gaining some technical insight as to what the direction we actually anticipate these particular pairs moving forward in, then this is an interesting place to check out, or an interesting presentation to check out on a weekly basis. What we try to do is we try to really just give a technical overview of the more popular FX options pair values. Just use some simple techniques to determine the probability of a direction. Ultimately, look for different clues within the chart to identify some potential levels where we could conceivably enter into a trade, and also areas where we might consider locking in profits or cutting losses in the event that the direction is not as expected. We always want to make sure that we're keeping an open mind, and this is very important when it comes to managing any option strategy, in that we want to go through our due diligence and analyze the market and create a directional bias, but at the same time we have to recognize, of course, that we're not always going to be right. And so with that in mind, we have to be prepared to admit that we're wrong, keep an open mind regardless of what the media and other information sources are suggesting. Just keep an open mind and recognize that at the end of the day, these currency markets are going to do what they're going to do, and we just want to take our cues accordingly and manage our risk accordingly as well. So at the end of the day, the main focus is that we want to use these weekly outlooks as a tool, becoming part of a trading plan that is focused on an appropriate level of risk management and capital allocation. So now that I've got that component of the presentation out of the way, one consideration for a market that is highly volatile is the idea that options become more expensive, and it really doesn't matter whether we're looking at the equity markets, whether we're looking at the commodity markets, or whether we're looking at the currency markets. When there is a certain expectation of volatility within an underlying security, ultimately what happens is that we see an increase in implied volatility, in the implied volatility of the options contract. So that would create what we would consider to be an option or an environment where options are expensive. Now, this implied volatility variable is really an adjustment, the probabilities adjustment of an options price. So in other words, we may be looking at the U.S. Canadian, we may be looking at the U.S. Euro, the U.S. Yen, et cetera, and that particular pair may not be doing much from an underlying perspective, but ultimately we see an increase in the option premium based on the expectation of its future value. So again, it's the probabilities adjustment for the options price, and it creates what's known as a probabilities distribution curve. Now, this is a little bit more perhaps in depth than what most people may get when it comes to actually learning about the options market, but it's important to understand just what happens in an environment where there is volatility, and it's important to understand why options do become more expensive, because again, what we have to understand is that in the options world, and it doesn't matter whether it's equity, whether it's commodity options, or whether it's FX options, such as what we're discussing here this evening, there is a market maker on the other side of the trade, and so that market maker has the responsibility of essentially being the buyer for every seller and the seller for every buyer. So in an environment where it is difficult for that market maker to assess the risk, or if they believe that there is significant risk or more risk in assuming the other side of the transaction, what do? Well, they ultimately increase the cost of the options contract. Think about it like your car insurance broker. If you are a high-risk driver versus a trustworthy low-risk driver, a trustworthy low-risk driver that is not at risk of an accident, well, your insurance premiums are going to be relatively low compared to a high-risk driver who has the tendency of having to get into an accident, whereby their insurance premiums will be higher. So again, it's the probability adjustment. The insurance broker for car insurance adjusts the premium based on the probability of you getting into an accident. And the higher the probability, and the higher the probability of that insurance broker having to deliver on the policy, the more expensive that policy is going to become. So this is really, and I've simplified the version, but this is really how that implied volatility variable works in the options market. Now, what this means is that for option writers, this is actually a period where we can actually get some healthy premiums for at the money or out of the money option contracts. So we're actually able to sell expensive option contracts and generate cash flow. And this ultimately creates income opportunities. So just kind of get back to this whole idea when it comes to the distribution curve of implied volatility of an option contract based on the underlying. Let's say we have an underlying security that's sitting at 90, and this could be any one of the pair, not necessarily any one of the pair values, but let's say that this, for example, is the CDD. Well, ultimately, under normal circumstances, a market maker would take a look at the trading behavior of the underlying and say that there is a 68.2 or almost 70% chance that the option or that the underlying security is going to actually settle between 85 and 95 within a particular time frame. And so they will adjust the price of the option contract accordingly based on that level of probability. Now, as soon as you get into a scenario where the environment changes, what happens is the market maker ultimately has to adjust for that change in probabilities. And so we see an expansion in volatility, which ultimately adjusts the option prices. So this rate of change, just for point of reference, is known as the vega, and that's of course one of the measures that we find in the series of option Greeks that reflect the pricing variables of an option contract. Now, the concept of expanding implied volatility would suggest that as that market environment changes, that distribution curve would expand, and now all of a sudden we have a 68.2 or approximately 7% chance that the underlying is ultimately going to fall within the 82 to 98 price range or value. And so with that in mind, the market maker has to recognize that when they're taking on the opposite side of the transaction, they may have to deliver, or they have a higher probability of having to deliver on their obligations based on that expectation of price fluctuation within that wider range. I'm just trying to take a look here and keep track of some of the questions coming in, and I have to apologize for folks. We have a lot of people online, and so these questions are rolling in very quickly. So if I'm not answering your questions right away here, guys, it's nothing personal. It's just a function of the level of volume that's coming in. So, one question, are we going to see any chart setups? Of course we are. I never do a presentation without throwing up charts. I show you some real-time ideas and hopefully give you some insight into how you could practically apply this information. The next question here as well is do we buy straight calls, puts, or will we trade complex strategies? Well, ultimately, for my trading characteristics, I will implement straight calls and straight puts if I feel the market warrants. I will trade debit spreads, which incidentally we are taking advantage of some debit spreads currently in utilizing ISE FX options, which are doing quite well. And of course, I'll take advantage of these strategies here that I'm going to discuss this evening, which would be considered a little bit more complex, but by far nowhere near as complex as one might get. One thing to keep in mind, guys, not without getting too much off track, but we have a little thing in our sort of, when we teach our members, and I know a lot of members online and students will say, oh, here he goes again. But, we have to recognize that in the options world, there are what we call bread and butter strategies, and there are what we call caviar strategies. And for the most part, we live on bread and butter. So we keep things simple, where we buy calls, buy puts, we do debit spreads, and we do credit spreads. And we leave the complex strategies up to somebody else. You don't have to get too fancy when it comes to utilizing, and taking advantage of these markets. So hopefully I've been able to answer some of your questions, guys. And again, my apologies if I kind of left you hanging there for a little bit. Nonetheless, let's move forward here and just discuss a little bit about the concept of option writing. Really, the principle is to sell expensive options for a credit. Now, don't get me wrong. This strategy can work in any market environment. So even if we're in a market environment where options are not necessarily considered expensive relative to other time frames, understand that we're able to collect a greater amount of premium as the option seller in a market environment where implied volatility is higher. Now, what it does is it puts time depreciation on our side. So in other words, the focus is not so much on timing the market and buying the option contract and then looking to take advantage of a move and then selling the option contract for a profit. It's about just looking at collecting a premium, holding that position over the course of a month or however long the time frame is that you've allocated, and ultimately as that expiration date approaches, option premium depreciates in value, and we are collecting that income. So these strategies are not designed for home runs, and this is the one thing that I want you guys to just recognize as well. When we talk about income-generating strategies, we're really looking about trying to create some passive strategies on utilizing these particular FX options, contracts that don't require us to be paying attention every single second of the day. Now, there's always a question. This question comes up all the time, and I'll just take a look at this last question that rolled in with respect to volume and open interest. And what we typically will see in any newer product is that you're not going to see it as heavily traded as equity option products that have been trading for years and years and years. But the important consideration is really looking at the bid and the ask differential between the particular contracts and recognizing that in the absence of anybody else wanting to do business with us, or regardless of the fact whether somebody else has has bought or sold those contracts to inflate that open interest, as long as we can buy and sell those option contracts at a price that is favorable to us, then it really, and this is at least in my mind, and I've seen, and I use this, this is the way I approach my trading with this particular product, is that as long as I'm getting a price that I'm comfortable with, and as long as I'm able to, in the case of creating, these kinds of strategies I'll talk about here tonight, getting a credit that I'm comfortable with getting, then it's I feel that it's appropriate to trade regardless of whether or not anybody else is taking advantage of it. Remember, we can always buy at the ask. We can always sell at the bid, and so as long as the bid and the ask prices fall in line with what it is that we're looking at, then ultimately it's comfortable. I'm comfortable with it. Now again, different products within the FX Options series of products available, maybe a little bit more thinly traded than others. My focus is to take advantage of the ones that are highly traded, and you'll find the ones that I like to focus on if you check out the FX Options weekly outlook that I do, and I'll show you some of the ones tonight. But understand that the trading characteristics are going to vary, Gianni, from product to product, and sometimes you may not get filled at exactly where you want to be, but we all have to make adjustments in that regard. So with that in mind, ultimately the benefit of being an options writer is that we get to profit even if the underlying pair value stays at the same price that we as the day that we sold the particular option contract. So it really creates a situation where if we're looking at a range-bound currency pair, the option buyer is going to get turned and burned on that rate of time depreciation, whereas the option seller is actually taking advantage of that time depreciation on a day in and day out scenario. Now, our typical objective is to create positions on a month-over-month basis. You're going to generate a smaller credit, but ultimately time depreciation accelerates within that last month of the expiration cycle. So we're able to capitalize on that and collect that premium on a relatively short period of time, and perhaps lock in 5 to 10% return on our capital within that particular time frame. And I'll talk about some of the considerations as we move forward as to how much premium we are collecting. The other benefit is that we actually avoid commissions on expiration. So, when we are going long a call or long a put option or creating a debit spread of some sort, if we're looking to close the position early, we're going to pay a commission to get in and we're going to pay a commission to get out. But if we're looking at writing option contracts with the expectation of those contracts expiring worthless, well, we don't have to worry about giving up that commission on the other side of it, because once those options expire, they no longer exist. We no longer have a position that we need to offset. So one of the challenges for the option writer is that they create an obligation. And so when we have an obligation, we have to recognize that there is an unidentifiable risk exposure. Now, the term that we use to refer to just an outright option writer, so if I sell a call or I sell a put without any additional option contract in there to identify any risk, is referred to as being naked. So the naked writer has an unidentifiable risk exposure. And as a result of that, the broker, whomever you're trading with, will require you to put up margin. So they're going to look at the fact that you have a position that obligates you to either buy or sell the underlying at a specific price, and will recognize that if that position goes against you, there is nothing stopping it from running away and accelerating your losses, and then of course accelerating the cost of your obligation, so to speak. So the naked writer has to understand the risks.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.